a minute, yeah.
Hi, good morning. My name is Andrea Torres Villanueva, and I'm a member of the funds rating team here at KBRA. It is a pleasure to be moderating today this webinar to discuss KBRA's rating of Nassau CFO 2022 LLC. The transaction is sponsored by Nassau Alternative Investments LLC, which is a division of Nassau Financial Group. So this transaction is a collateralized fund obligation, and it's the first that is publicly rated by KBRA. And today we hope to summarize KBRA's key credit considerations for this transaction and answer questions from marketplace participants. I want to remind everyone that KBRA's rating report and related methodologies are publicly available on our website, www.kbra.com. And with that, I will turn it over to our speaker, Gopal Narasimhamurthy, to introduce himself and provide a brief overview of the transaction.
Thanks, Andrea. Good morning, everyone. My name is Gopal Narasimhamurthy, and I'm also a member of the funds rating team here at KBRA. Nassau CFO 2022 LLC, like Andrea said, is a collateralized fund obligation, or CFO, as we'll refer to it as over the course of this webinar. The transaction is a securitization of 52 limited partnership interests in seasoned private capital funds, both private equity, private credit, as well as other sort of sub-asset classes that were previously owned and committed to by Nassau Financial Group and its affiliates. The total net asset value of these LP interests at closing was approximately $430 million, with a weighted average seasoning of just under 4 years, ranging from vintages of investments as far back as 2005 to as recent as 2022. The transaction also consisted of a $50 million revolving liquidity facility rated by KBRA, in addition to the 3 classes of rated debt at advance rates of 50%, 15%, and 5% respectively, along with 1 tranche of subordinated notes representing the remaining 30% of the capital structure. The rated debt has a legal maturity of 15 years following the transaction close and is rated by KBRA to the ultimate payment of interest and ultimate repayment of principal, while the liquidity facility is a stated maturity 5 years following close, and our rating reflects the timely payment of interest and ultimate repayment of principal in that case.
Thank you, Gopal. Can you provide a bit more detail around the transaction legal structure?
Yeah, absolutely. So this transaction is structured in a manner that's very similar to broader securitization deal flow, and it's consistent with structured products. So the rated debt is secured in this case indirectly by the portfolio of LP interests by way of the issuer's acquisition of what's referred to as an asset co vehicle, and a pledge of the LLC or equity interests in that asset co. So in the event of a default, and the trustee at the direction of the investors and the controlling class of the structure at that point in time can take control of the asset co vehicle and direct the manager, Nassau, or an appointed manager at that time to monetize the assets within the asset co to start to realize recoveries.
Thank you. And can you walk us through the key determinants in KBRA's methodologies for assessing this transaction, and also which determinants were most meaningful to the rating outcome?
Yeah, happy to. So I'll try not to be too long-winded here, but so KBRA's investment fund debt rating methodology is the primary methodology that's utilized for purposes of rating a transaction like this. And the methodology consists of 5 quantitative rating determinants. But for purposes of this transaction, and for a variety of reasons that I'll get into, there are really 3 quantitative determinants that are most meaningful that I'll walk through in a bit of detail. So first is what we refer to in our methodology as asset quality. And that determinant is really intended to capture the weighted average credit quality of the pledged collateral. In this case, the collateral consists of LP interests in private equity and private credit funds, as I said before, with some allocation to mezz-focused strategies as well as real asset-focused strategies. While the asset mix here, when looking through the LP interest to the underlying portfolio of collateral, certainly consists of meaningful exposure to credit instruments, at the end of the day, the collateral for the investors in this transaction are the LP interests. And so our scoring for this rating determinant is really reflective of equity or equity-like risk because of the nature of a limited partnership interest security. The second determinant that's critical is what we refer to as asset coverage. This determinant is really intended to capture the credit protection provided to the investors in the structure by way of structural subordination. So you can think of it as the inverse of a loan to value. So for the Class A notes, at a 50% advance rate, the equivalent asset coverage is 200%. For the Class B notes at 65, the equivalent asset coverage is 154%. And for the Class C notes at 70%, again, 143%. For the liquidity facility, which we also rate, The approach is not quite as straightforward, but for purposes of our LTV calculation, we assume a fully drawn liquidity facility and determine the value, the LTV relative to the current net adjusted value, that 430 million that I said before. And that LTV shakes out to about 11.6%, which is an equivalent asset coverage of 862%. The third quantitative determinant that's most important, and I'd say arguably the most important for a transaction like this, is what we refer to as cash flow analysis. And in this determinant, we consider a number of things, but at the end of the day, the importance of the cash flow analysis determinant is to consider the ability of the structure to absorb and withstand losses consistent with historical observed market cycles, and then to consider the break-even level or the max level of underperformance at stress, or stress that the collateral can withstand while still being able to service the interest and principal obligations on the rated portions of this structure. And ideally, what we'd like to see, particularly at investment grade levels of risk, is the ability to sustain certainly observed levels of stress and ideally beyond that. And our ratings really consider that meaningfully. And I'll get into that approach in a little bit more detail. We also want to consider and quantify the importance of various structural features in the transaction, obviously structural subordination being most important, as well as things like reserve accounts, as well as all the triggers that would lead to a sequential amortization or accelerated amortization of the rated debt in seniority. I want to highlight a few key assumptions within our cash flow analysis. First and foremost, as would always be the case, in this case, Nassau is a sponsor of this transaction, and the other parties involved in this transaction provided KBRA with the cash flow model. And in that model included projections of forward-looking capital calls and distributions and valuations that ultimately drive, in aggregate, the repayment of the debt. And so just for the purpose of example, and you'll see this on our report, Nassau assumes as part of their analysis, let's call it the baseline here, that in aggregate, the value of all future distributions will be about 48% higher than the current net adjusted value of the assets plus any future funding obligations. So you can think of it almost like a TVPI of a 1.48. And what we do, taking that baseline projection to start off with, is we start to run sensitivities to that. So those sensitivities could be a variety of combinations of reducing distributions, and we try to reduce distributions to benchmark to market standards. So for example, reducing those distributions to historically observed third quartile levels of performance or fourth quartile levels of performance to see, like, relative to historical market trends, what level of underperformance could in aggregate these underlying LP interests withstand while being able to service the rated debt. And then we also think about break-even levels of stress as well, right? So what's the maximum level? And again, ideally, we'd want to see that at a level below historical market trends. And we certainly do see that observation in large part in this transaction for the more senior classes of debt here. Another kind of key assumption I want to highlight is around valuation. Valuation is a critical consideration in our methodological approach and certainly in our cash flow analysis. The transaction is protective in many ways by way of structural subordination, but also by way of LTV triggers to each class of debt. And the breach of those LTV triggers would result in an accelerated repayment to the most senior class of debt at that point in time. So it is very important for us to get a good sense of how these assets are going to be valued. And the way that we go about that is to look at historical market trends, obviously to look at Nassau's projections, and then sensitize that. So for purposes of our cash flow analysis, we consider scenarios where valuations deviate from actual performance. In other words, the underlying GPs managing each of these 52 LP interests are getting their valuations wrong, right? Now, is that always the case? How stressful is that? That's a function of historical observations in the market, and we do that analysis off of a base of considering what's happened in the past. In addition to that, stepping away from the projections that Nassau provides us with, we run what we loosely define as composite analysis internally at KBRA. And that's leveraging, again, historical market data of fund inflows, fund outflows, segmenting that performance by strategy, and by on average for different vintages and segments and geographies, as well as performance quartile. And so we'll use these fund inflows, outflows, as well as reported valuations to construct portfolio compositions that are intended to mimic what the current collateral look like by way of vintage allocation, seasoning, and strategic allocation, but using historical observations to drive our performance assumptions. So a simple example of that, right, is 44% of the current NAV at closing approximately represents allocations to private equity. So we'll construct representative portfolios at different historical periods of history with similar allocations to private equity. In addition to strategic allocations, the vintage allocations are also similar. So for example, if in our current collateral pool, there's an allocation to a 2019 vintage buyout fund, so call it a private equity fund with buyout focus that's 3 years seasoned, we'll look at that same portfolio composition, but using 2004 as an anchor point, but then allocating it to that 2004 portfolio, a 2001 vintage buyout fund, right, of a similar allocation, right? And then the performance of that collateral will be reflective of how the 2001 vintage buyout funds, call it third quartile performed or fourth quartile performed, or on average they performed, right, to drive some of those analyses. And so these allocations inform us of the sensitivity of this transaction to vintage specific performance and historical market volatility that's actually been observed. In addition to that cash flow analysis, I want to highlight a couple of key qualitative points that are important. The manager review. In the context of a CFO, the manager review is really more of an operational review of the sponsor and the ability of the sponsor to meet its obligations, both its financial obligations in this transaction, as well as the operational obligations that are quite intensive when managing a securitization. And so in this case, as we always would, we spent time with the Nassau team, getting a good sense of their organizational structure, their servicing capabilities for this type of transaction, as well as gauging their ability to meet a financial obligation in this transaction if needed, but not required. And so in our view, and our ratings reflect this, the Nassau team, particularly the team focusing on their private capital initiatives, is certainly more than capable and experienced in this realm as well. And I also want to mention ESG. ESG is always of the utmost importance within our credit analysis. We consider the ESG related investment considerations that Nassau incorporates as when they diligence potential investment opportunities, as well as the ESG considerations of the managers in which they invest as part of our diligence process, and certainly incorporate those considerations in our ratings as well.
Thank you, Gopal. So you mentioned key quantitative and qualitative factors, some of which are more important than others, but how does alignment of interests factor in, and where is this considered methodologically?
That's a great point. And so like any transaction, the alignment and the continued assurance that the key parties involved, in this case in particular Nassau, are continued to be aligned in how they manage this transaction, how they manage portfolios, how they manage distributions and any funding obligations, as well as just ensuring that this performs right at the end of the day. And so there's quantifiable ways of defining that, as well as many qualitative ways, I think, which are equally important. From a quantitative standpoint, Nassau is the majority investor in the subordinated notes, and they're required to retain, for as long as the notes are outstanding, a meaningful portion of the subordinated notes in the structure. And the ultimate performance of those subordinated notes are directly derived and correlated to the performance of the notes. So frankly, the more quickly the notes get paid off, subject to the performance of the underlying LP interests, the better the return on the subordinated notes. So again, there's an assurance that the structure will be supported if needed, and that Nassau is capable and incentivized to continue performing it in a way that's been consistent with their track record. In addition to that, what is unique but common for CFO transactions is the fact that Nassau is also what's referred to as a preferred investor in this transaction. And so effectively, as a preferred investor, Nassau has the optionality to sit in line with the liquidity facility to provide funding to the structure to meet any potential periods of illiquidity where you would have otherwise relied on the liquidity facility to either meet a capital call, support interest payments, or any other expenses of the issuer. Nassau has the ability to step in and provide liquidity to the structure in lieu of the liquidity facility and collect a similar return. And so the fact that they're willing to step up to that, I think, is also a positive sign of ensuring that there's continued alignment and support of the structure to the extent needed.
Great, thank you. And I'm sure some listeners are aware that KBRA is active in rating what are loosely called rated notes. So essentially the issuance of rated debt that is issued to invest in single fund or multiple funds by way of an LP interest. So there seems to be many parallels between those transactions and this transaction. So can you walk through the similarities, but more importantly, the key differences between these two and how we evaluate these transactions? Yeah,
absolutely. So you know that in the sense that there are many parallels and that the collateral for a rated note transaction is an LP interest or multiple LP interests into private capital funds, as is the case in the Nassau transaction. But there are a number of distinctions. I'll maybe step back and talk about like what a rated note is, just generally speaking, which is typically the issuance of a single tranche of debt with equity or multiple tranches of rated debt, and the proceeds of that rated debt are used to invest in a single fund or multiple funds. So the motivations there are more primary capital fundraise and a way of, for example, among many things, diversifying an investor base, diversifying capital sources to grow the size of a fund and to grow AUM for a manager. And so it's been a growing piece of our business here on the funds team, and certainly a unique but more common structure that we're seeing in the marketplace broadly. Now, what's similar about these transactions? I think one thing that's certainly similar in large part is our cash flow analysis, right? Where we're modeling to the historical performance of a particular manager or managers in the case of Nassau, and certainly considering broader market trends in terms of what's the typical timing of capital calls and distributions for a particular asset class, for a particular geography, and how is that varied over time. So a lot of that philosophy is incorporated in the rated notes as well. But what is different is which may be obvious but causes distinctions in our approach, is the fact that in the rated note space, a lot of the collateral is unidentified, I should say. In other words, a blind pool, right? And so that creates a little bit more uncertainty as to what the ultimate ramp up of the assets is going to look like. Unlike in the Nassau transaction, where you've got 52 LP interests, you've got managers, 35 managers in this case, that are identified, that you can evaluate their track record. And while there's still continued funding obligations, and a lot of these funds are in their investment period, in large part, again, given the transaction seasoning is about 4 years, the underlying investments are also largely identified. And so you can get a really strong sense of what the quality of those investments are, how the value of those investments have changed over time, versus a blind pool where you're really looking to the track record of a manager, right? And so what all that comes down to is perhaps a little bit more conservatism in the cash flow analysis and how we think about that cash flow analysis, and certainly a lot more reliance in that case of the manager themselves and what's their track record, over multiple economic cycles, and how can we think about their scope, their scale, the comprehensiveness of this investment process to give a little bit more certainty to ourselves as a rating agency, and ultimately, most importantly, the investors in these structures, that the quality of the investment that they're going to make in that case will represent something similar to what they've done in the past. And so it really comes down to the manager. In addition, I would just mention there are obviously some legal distinctions, which we won't get to too much detail on this particular webinar, between a rated note, the structure of those rated notes versus a CFO, in this case. Yep.
Thank you. And we briefly touched on the liquidity facility over the course of the discussion, but can you expand on the importance of this liquidity facility for this transaction, the purpose it serves, and how we evaluate the risk of non-payment to the liquidity facility lenders? And also, can you discuss why this facility has a 5-year maturity relative to a 15-year transaction, and how do we get comfortable with this mismatch?
Yeah, absolutely. Look, I think with this transaction, the presence of a liquidity facility is critical. Now, what is a liquidity facility there for? It serves multiple purposes, right? Private capital and LP interests inherently have uncertain distribution profiles, uncertain timing of when a capital call is going to be made. And so the liquidity management element of managing a diverse portfolio, even as a typical LP outside of a CFO structure, is always critical, right? To have a little bit more certainty as to what your cash needs are going to be. And so for this transaction, right, given that uncertainty, the expectation in large part is that the distributions from the underlying LP interest will be able to service a meaningful portion, if not all, in entirety of any remaining funding obligations associated with those same LP interests. So there'll be a lot of recycling, but there's no certainty of that. That could be driven by performance. It could be driven by periods of illiquidity because of market dislocation. And so at an investment grade level of risk, which is critical to us, we need a little bit more certainty of that the ability to meet those liquidity needs. And so the liquidity facilities in place to service those capital calls, most importantly, service any interest obligations on the rated pieces of the capital structure, as well as meet any expense obligations, any interim liquidity needs of the structure that might be required. I want to also just mention again that Nassau, as a preferred investor in this structure, has the optionality to also step in and provide that same source of funding from their own balance sheet, which again, from an alignment standpoint is positive, but they're not, certainly given the optionality, not something that our ratings are reliant on in totality. And so the liquidity facility is a critical piece, coming back to your original question. The last piece of your question on the maturity mismatch and how do we get comfortable with that deviation between a 5-year maturity on the facility and the 15-year maturity in the notes is a great point. There are a couple ways, and in large part it's qualitative. First of all, coming back to alignment, right? What we understand to be the case is that to the extent the liquidity facility needs to be extended based on forecasted liquidity needs, as we get closer to that 5-year maturity date, that's something that we'll monitor very closely, and we'll want to make sure that Nassau as the sponsor and the investors in the structure make the right decision for purposes of supporting that structure to extend that liquidity facility. stepping back from that conceptually, what's the probability of that? When you think about a portfolio that's 4 years seasoned, that in large part, again, given that range of vintages, is harvesting meaningfully in the next few years, the forward-looking liquidity needs post year 5 should be, again, subject to market conditions, a little bit more limited, right? And so you would hope and you would expect, and certainly the modeling reflects this, that the recycling of distributions in the structure at that point should be more than sufficient to meet those calls. But again, if there were to be underperformance, our expectation, certainly given the alignment of Nassau with this structure and the somewhat binary risk of not being able to meet your funding obligations, would suggest that the liquidity facility will be extended or alternate liquidity sources will be identified, again, in a scenario that's a little bit more extreme.
Perfect, thank you. So we will now move on into the audience questions. I have here a few that were sent in advance. Let's start with this one. Can you confirm whether KBRA's methodology provide for a reinvestment period?
Yeah, great point. So our methodology doesn't speak to this point directly one way or the other. But what I can tell you is, to the extent a transaction like this included a reinvestment period, what would be critical in our consideration of ratability and certainly rating outcome would be the certainty of what those new investments would look like. So is there eligibility criteria in the documents about either manager quality or particular asset classes or maximum concentration limits to a single asset class, to a single GP, if you can look through to the portfolio companies, even to a single sector, right? To ensure that the ultimate ramp up, as we think about in the rated notes world, going back to your earlier question, provides a little bit more certainty, right? And so that eligibility criteria is going to be important. The other thing that's important is in the reinvestment period, again, going back to our last topic on liquidity, is the vintage and the seasoning of the portfolio as well. So will there be certainty as to the minimum weighted average seasoning of the portfolio, in addition to the diversification considerations, to ensure you're not investing or recycling into unseasoned investments or primary investments that are going to be illiquid for several years at a minimum, right? And so again, while it's not a binary point of reinvestment period works or doesn't work, there are certainly ratings and methodological consequences of putting in a reinvestment period that could be positive, negative, or neutral.
Okay. Then how many opportunities are you rating against an existing collateral pool versus a blind pool vehicle? Yeah, so we look at transactions backed by LP interests in several different contexts, just to step back, right? CFOs is certainly one of them, right? Although it's a very small part of KBRA's funds rated portfolio, right? We also look at rated notes, which, as I said before, are blind pool, right? Where the assets are either entirely or substantially unidentified at that point in time, although the funds themselves are identified and the strategies are identified, but what those ultimate investments look like is where you're relying on the manager. However, a meaningful portion of our rated portfolio consists of fund finance or NAV loans, right? 2 secondaries funds as an example, right? And in that case, the portfolios are entirely identified, right? So I would say, while I can't put a particular percentage on it, a substantial majority portion of transactions we rate are where there's an existing collateral pool where we can evaluate the diversification, the quality, and the expectations for performance quite clearly. Yeah. And we've touched on this a bit already, but what type of haircut or stress do you put on the underlying funds to support the ratings?
Yeah, absolutely. So again, our methodology doesn't speak to specific haircuts because, and the reason for that, just to step back, is it's important for us to think about the magnitude of stresses, the outcome of stresses in the context of the quality of the investments and the motivations of the transaction, right? So a really simple example of that is, let's say we applied a 50% haircut to distributions, which equated to, let's say, a resulting MOIC of 1 times, right? Now, what does a 1 times MOIC mean? How do you contextualize that? The way that we would contextualize it is by looking at the quality of the underlying investments, the quality of the underlying sponsors, what their track record is. And if you're talking about, in large part, a portfolio of sponsors with strategies that have historically been both sort of first quartile, second quartile performance, and consistent within that band, then the likelihood of achieving a 1 times MOIC may be a little bit lower, right? Versus if the quality of the underlying portfolio, the quality of those sponsors is either a little bit more limited, which can often be the case, or certainly more volatile, then the probability of a 1 times MOIC and the correlations within that portfolio may be a little bit higher. So the way we contextualize the magnitude of the stress, the way that we score it, and how we think about how that drives our rating is very much a case-by-case approach. So we don't want to be bound by absolutes for that exact reason.
And then this is the last question that we received. How do you cater for valuation uncertainty and fundamental quality of the assets in the respective funds?
Yeah, so that's a great point. Again, to emphasize valuation, when diligencing a particular manager, one of the things that we think about extensively and discuss extensively is that manager's valuation policy, to get an understanding of the frequency of valuing their underlying portfolios, the comprehensiveness of that valuation approach, the inclusion of third-party validation of those valuations to ensure, and then the testing of those valuations over time as well, right? So if a portfolio company, as a simple example, is valued at $100, right? You want to ensure that, and if that value was a quarter before they actually monetize that investment, you want to ensure that they sold that company for about $100, ideally $100 or more, right? Versus if you valued at $100 and sold for 80 consistently, what that would imply is there's a little bit of a disconnect in the valuation approach at that particular GP. So at a single manager level, that's something that we diligence all the time. Structurally, more importantly for a CFO like this, we think about the potential deviation of valuations to distributions, right? Particularly given the importance of an LTV trigger, we always test what that variance can look like. So for example, if the unrealized value, again, sticking with my $100 example, if the unrealized value of a portfolio is marked at $100, what if the realized value of that associated collateral is $50 or $60 or $40, right? What is the implication and the impact of misvaluing your portfolio on the structure? The consequence usually is that you're less protective to your more senior classes of debt, right? You allow more leakage, as we call it, to more subordinated parts of the capital structure, even to the equity or the subordinated notes in this case, because of the misvaluing of the portfolio. And so all of our cash flow analysis considers those deviations as a base case. And then we look at historical vintages and observations. So for example, a 2004 vintage buyout fund, one would think, and I'm sure there's many exceptions, at some point might have held the value of its investments at a level higher than what they ultimately monetized it, right? So what was that deviation? That's a lot of time. We spend a lot of time thinking about that, researching that, and helping that drive context for how we think about the strength of the structure.
Thank you. Let me just check if we got any other questions to it. Okay. That's fine.
Oh, that's a great question. Yeah. So
So it says access to the liquidity facility is ultimately dependent on the discretion of the lenders. How do the ratings analysis consider non-performance by the lenders in a stress scenario?
Yeah. So this transaction and really any transaction rated by KBRA where there's a liquidity facility that's present and relied upon has minimum ratings requirements for a liquidity facility participant. And you can sort of think about our approach to that liquidity facility as how one would think about significant counterparty risk in any other securitization, right? So the minimum ratings requirements for those liquidity facility participants is something that we monitor over time. If there's a deterioration in the quality of those liquidity facility lenders, our ratings may reflect that and may allocably be downgraded to reflect that over time. Unlikely scenario. But that's really, frankly, the fundamental way that we think about it, right? Now, there's no perfect correlation, right? Like, a liquidity facility lender has the obligation to fund, right? But to the extent that they don't, that's where having the preferred investor contribution and Nassau's willingness to step up, at least in an interim dislocation, becomes critical. There's also contemplation in the structure of replacement of liquidity facility lenders, substitution of lenders, all of which are critical pieces to inform the active management of how that facility will be managed over time. But again, to the sort of the crux of that question, it just comes down to who are the lenders, our views of their credit quality, their ongoing credit quality over time, and what the mitigants are to the extent there's an interim dislocation despite all those protective measures.
Just see if there's another one.
I think that's all we got.
Perfect. So if there are not any other questions, just going to wrap up our discussion today. Thank you very much, Gopal, and thank you all very much for joining today. Please do not hesitate to reach out to any of us here at KBRA with any further questions you have on our methodology of this transaction, and have a great rest of your day.
Thank you, everyone.